Welcome to the Bigger Cash Flow podcast, where we interview business owners and real estate investors that share tips and tricks on how to grow your cash flow and reach financial freedom.
Welcome, everybody, to another episode of the Bigger Cash Flow podcast. Today's episode is all about conventional financing for your investment properties, and I'm very excited for this episode. Today, we have Sean Huss from Chemical Bank. Sean is the Senior Vice President at Chemical Bank based in Ohio, and he has been in the mortgage industry for over 26 years. He specializes in home refinances, home purchases, construction loans, renovation loans, FHA, VA, conventional financing for investment property, and owner-occupied. I hope I didn't miss anything, but welcome to the show, Sean.
Awesome. Thank you very much, Bo, and I appreciate the introduction and definitely appreciate the opportunity to educate the investor world on mortgage lending.
Yeah. How about we dive right into it? Tell me a little more about yourself and what you provide, especially in the investment owner space.
We are a small community bank mentality. So when I share that, basically what that means is we're slightly different than the bigger banks where you kind of get lost in the shuffle. So me personally, I've been doing this in the industry for 25, 26 years. Basically been nationally ranked in the top 1% for the last 18 years out of all lenders in the country. So I'm personally based out of Cincinnati, Ohio. Our corporate, it basically is based out of Michigan, actually the Bank of Detroit. We just got recognized for being 100 years in service in the state of Michigan, based out of Cincinnati, but I can work with investors all over the country. There's only 2 or 3 states I cannot assist in. That would be Texas, New York, and New Mexico. That's just because they make it a little bit tougher for outside banks to basically go in and provide financing for customers in that area. So pretty much I can lend nationwide. It doesn't matter where the properties are. It doesn't matter where the investors are. We like to say we're a very investor-friendly bank. When I say that, there's a lot of different overlays you will hear out in the industry. When I say overlays, basically Fannie Mae and Freddie Mac will allow you to go up to 10 finance properties. Chemical Bank will do the same. Some banks will cut you off at 4. Some banks will cut you off at 6. Pretty much, so we close probably 50 to 60 investor loans a month. So my processing, my underwriting, my closing all sits right outside my door. So basically it usually provides more efficiencies, faster turn times, and we can get answers quicker because I can put the customer on hold, go speak to an underwriter, and come right back and provide that answer 90% of the time. So pretty much that's what separates us from the bigger banks in the investor world.
That's awesome. That was a lot there. So let's unpack a little bit of that. For our listeners, you guys might know with my portfolio, I love to invest in the markets of Kansas City, Little Rock, and Indianapolis. And Sean has been my go-to lender for all of my rental properties. So a huge benefit that I saw working with Sean and a national lender, as Sean mentioned, his underwriting sits right in front of his desk. So the communication, it's really smooth. And also having a national lender in the presence of different markets allowed me to just stay with one shop and get qualified for 3 different markets. That means less paperwork submitted as they have most of my data if I continue to get more loans with them. So that's a side benefit that I wanted to share with my listeners. Sean, is there any differences and similarities from the primary residence versus the investment properties?
Basically, the similarities are you still have to qualify. So it's all a debt to income qualify. The only differences between investment lending and primary residence is obviously you can put less money down on primary residence. So on primary residence, you can put as little as 3% down. I mean, there's some programs where you can do 0%, such as veteran loans or things in that respect. But with the owner occupied, basically the down payments are slightly higher. On a single family property, you can put as little as 15% down on a single family. Most investors were going to put 20% down just to avoid the PMI, which creates greater cash flow. If it's a 2 to 4 family, Basically, you're required to put at least 25% down per the Fannie Mae, Freddie Mac guidelines. But credit score wise, all the scores are similar, meaning you have to have a minimum 620 credit score for primary or investment lending. Obviously, the higher your credit scores, the better the closing cost and or the terms you're going to get on the mortgage, strictly based on credit score. So 740 and higher gets you the best pricing for your loan.
Okay. So one thing that I personally use is Credit Karma, and I check my credit score weekly. And I was just curious if you had any insight into the differences between how we do a soft credit check, like our personal, versus the actual hard inquiry that is a FICO score. Is there going to be a big difference with that? And how can investors kind of prepare to make sure that they have the best credit rate?
That's a great question. And there's not an exact science to when it comes to credit scoring. So a lot of times when customers come to us, they'll say, don't pull my credit. I've got 740 credit scores according to Credit Karma. We've got this. We see this on a free report from Discover or whatever the mechanisms out there that gives a client their scores. So when they apply for a mortgage loan, basically it's a different scoring mechanism that the industry goes through to get credit scores. So when people come to me and talk about pre-qualifications, my recommendation is let's go ahead and get a formal pre-qualification ready, because most of the time the scores I pull for a customer are going to be lower than the free credit score pools that are out there. So why that is, I believe there's just, a different scoring mechanism that the credit agencies use when it's mortgage related as opposed to the free scores. So credit reports are good for 120 days, but when we're talking to an investor up front, we want to make sure we have everything in line. We want to make sure they're formally pre-qualified, pre-approved, because once they get out on the streets to find their next investment, there's way more investors out there right now than there is of inventory. So by getting the formal pre-qualification done, having the full credit check done, basically you're pretty much vaulting yourself to the top of any lists with different turnkey providers that are out there. So basically with credit scores, sometimes when you get the soft pool, it is one score. Well, for mortgage lending, we're going to use all three credit scores, all three agencies. Then the score we're going to use for each person would be the middle of those three credit scores from Equifax, Experian, and TransUnion.
Great. Okay. And I think you kind of pointed to it. It's a natural segue to the pre-approval process. Is the pre-approval the same thing as a pre-requisition, or is there a difference?
There's not really a difference. Every lender calls it slightly different. As far as some banks call pre-qualification different from a pre-approval, they're pretty much the same thing. It's just, again, some lenders will classify them as different things. In our world, a pre-qualification is we're going to verify your income, we're going to verify your assets, we're going to verify your credit scores, and make sure that you are basically qualified to purchase a rental property. One of the things, part of the investment lending, we will a lot of times, most of the time, we'll use the rent from the subject property to offset the PITI payment. So most of the time when you're buying investment lending, the subject property, the property we're getting financing for, does not affect your debt to income, because we're going to use 75% of whatever the lease is on that property, or the market rent, which is established by the appraisal, to help offset that payment. So a lot of times that doesn't even play into your debt to income calculations.
That's great. And I'm glad you mentioned this, because that's a discussion I have with a lot of investors in terms of using the 75% of the rent to offset the PITI. Is this something that's done across the board at all banks, or could that also be an overlay where other banks don't necessarily take that into consideration?
That's a great question as well. So some banks will not take it into consideration. There's two major industries out there, or two major giants out there, I should say, Fannie Mae and Freddie Mac. Fannie Mae will look at it where you can use 75% of the rents and leases. Freddie Mac wants to see a 2-year history in order to use the income on that property. So as we go into the future, Fannie Mae or Freddie Mac are more aligning themselves together. But so some banks that are Freddie Mac driven basically sometimes will not use the lease. They're going to look for that 2-year history, which if it's a new property, there is no 2-year history. In Fannie Mae, there's other banks that are aligned with Fannie Mae that basically will go with the lease times 75%. But again, I have seen some of the smaller banks create their own overlays stating that they have to go to the worst of the two. Chemical Bank, we sell and partner with both Fannie Mae and Freddie Mac. So we basically can take the better of the two situations working with Chemical Bank.
Okay. Yeah, thanks for clarifying. I think that's so important because, when I talk to investors and I tell them, hey, I'm using 75% of rents for my subject property, they look at me like I'm speaking a different language. And it's basically, like you explained, every bank might have different requirements, overlays, and the industry giants that they're working with, Fannie and Freddie, might require to do different things. So, it's very important to take note of this when you're shopping around with different lenders and getting different pre-approvals. Make sure you understand what is a Fannie Freddie requirement versus what is an additional bank overlay. All right, we're heading into the pre-approval process. Can you kind of tell me about, some of the documents that is looked at? What is the underwriting process in terms of what an investor needs to be aware of for their pre-approval?
Yeah, so pretty much as we get to the end of this, basically I'll give you all my website that you can go and visit at any time to start your own pre-approval process. Once you apply online, basically what I'm going to shoot you a quick email back that says we're going to need your last 2 pay stubs. We're going to need your last 2 years W-2s and federal tax returns. We're going to need your last 2 months bank statements for checking and or savings. That would cover the assets needed for down payment, closing costs, and reserves. And we can get into reserves a little bit later. And pretty much like a photo, a copy of your driver's license. So the list is not hard. It's very simple to get pre-approved, pre-qualified. So basically what would happen is you apply online. We would basically send you a detailed list. Once we get your financial package back, we'll review everything, make sure you are qualified. Once you are qualified, we will basically let you know you are pre-approved, or I'm sorry, pre-qualified, same thing, for X amount. So the creative world of investment lending is if you're qualified for $50,000, you're qualified for $300,000. The reason for that is because of the conversation we just had. So we'll use 75% of the rent to offset the mortgage payment. So most of the time, 75% of the rent is equal to or higher than the PITI, the principal and interest, taxes, insurance payment. So when that happens, again, it does not affect your debt to income. So a lot of times investors come to me and they'll say, okay, what's my max? I'm like, whatever you want it to be. And they kind of look at me like it's an open check. Well, pretty much it is when you're in the investment world, because again, most of the time, 70% of the market rent will equal or exceed the rent payment. And when the rents exceed the mortgage payment, it actually creates additional income for you, which I've seen often, which basically adds to your purchasing power.
Yep. And I think you're exactly right. I mean, I personally invest for cash flow, not appreciation. So in a perfect world, each property that I buy, even after 75% of rents, and then you subtract the PITI, you should still have extra cash flow that's going to actually help your DTI for the next project and the next project. So I think that's important to keep in mind as well. The reason why I was asking you about the documents requested for the pre-approval is just want to make sure once they get pre-approval and they find a property and they come back to you and say, hey, Sean, I want to put this under contract. At that point, it's not the same process all over again where they have to provide everything one more time, is it?
No, basically what will happen is once we get the form of pre-approval, pre-qualification, and you find a property. So the pre-qualification is good for 90 days. Your credit pool will be good for 120 days. So what would happen is once you find a property, your pay stubs and bank statements have to be within 30 days of the application. So worst case scenario, if it took you 60 days to find a property, we're going to come back and ask for updated pay stubs and bank statements only. So we keep all the customers' files in a secure location. So basically, when they buy a number of properties, 2 and 3, we can pull from their old files, documentation that we've already have, so that we're pretty much just updating pay stubs and bank statements for 90% of the borrowers out there.
Yep, that has been my experience. And I think that's another strength of working with one lender is that, they have your old information. And one of the difficult things about being an investor is sometimes getting all the paperwork together, right? We're really interested in the hunt and we love the acquisition piece, but in terms of bookkeeping and, preparing our documentation for financing, we might not be the best at that. And this is another way to kind of cut into all of that time spent into gathering your paperwork because your lender should already have it. So let's move on to scaling up your portfolios. I personally am not in the game to buy one and then just stop, right? I want to scale up to 10, 20, 30, and continue to build up that cash flow. I know a lot of other investors are wondering the same thing. And as you alluded to earlier, Chemical Bank allows up to 10 properties. And the important distinction is per person. So if you have the partner or if you're a husband and wife team, you can get 10 loans in your name and 10 loans wife's name as well. Can you kind of talk to our listeners about scaling your property and if there's any differences as you grow from 1 to 10 in terms of requirements by the lender?
Yes. Basically, as you just mentioned, each one person can qualify for a maximum of 10 finance properties. So say you already have one property, your owner occupied residence that has a mortgage on it, that means you have 9 slots left. So a lot of times when I have a couple apply online through myself and I see that they'll each qualify individually, basically I'll go back to them and have that conversation to say, hey, you might want to do loans individually. Because you each can have 10 slots. So even if you don't think you're going to go above 10, basically, if the first 10 is really that going that well for you, you're going to kick yourself in the future for not leaving the extra 10 slots open. Because once you go over 10, basically it's a whole different world. It's portfolio lending, it's commercial lending, which basically the terms and conditions usually aren't as attractive as they are in the residential world. In the past, there used to be different criteria for properties 6 through 10. So, and about 2 years ago, they've changed that. So basically, properties 1 through 10 basically have all the same characteristics. You can put as little as 20% down on single families, 25% down on multifamilies. The only changes as you increase your real estate portfolio is once you get to properties 7 through 10, you are required to have a minimum credit score of 720 or higher. So again, once you get to property 7 through 10, there's a harder line on the credit scores. And as you grow your real estate portfolio, Fannie Mae and Freddie Mac have recently changed how they calculate reserves. So reserves are monies that you have extra after you close on a loan and you bring your down payment and closing costs to the table. So pretty much what reserves means is the higher you get in loan size, the number of loans you get, the more reserves you need. So, and again, it's not an exact science, but now they calculate it based on unpaid principal balances, where in the past they used to do like 2 months PITI payments, and they would go to 4, then they would go to 6, depending on how many properties you own. With reserves, we can use different things for reserves. We can use obviously checking savings accounts. We can use any retirement accounts. So if you have an IRA, 401k, we'll use 60% of whatever your balances are in there to help offset reserves, assuming that you can withdraw those funds. You do not need to withdraw those funds. You just need to be able to show us that you do have access and it is a choice in order to be able to use that asset as a reserve moving forward. So pretty much 1 through 10 is a very similar transaction from start to finish.
Speaking of being able to use different sources of funds for your reserves, I don't think we touched on this earlier. Can you speak briefly about what are considered seasoned funds that investors can use for down payments on their rental properties?
Yes, seasoned funds will basically be funds in your account for minimum 60 days. So when you're doing investment lending, you cannot get a gift for down payment and or closing cost. Basically, all the funds have to come from your own personal account or a joint account. So a lot of times we'll see husband and wife, one of them getting a loan, and then the other spouse is saying, hey, I just gave him $25,000 for the purchase. Well, if his name or her name was not on that original statement, we can't use those funds, because even if it's a marital asset, but it's only in one person's name, the other spouse cannot use that asset for minimum 60 days until it seasons in their own personal account. So pretty much we have to use that for if you were, say you had a second mortgage home equity line of credit and you want to use your equity line of credit, for down payment. Well, that equity line of credit is an asset, and there is not a seasoning requirement for that because it's almost a liquid asset that has your name on it, that you can basically just pull the money out 2 weeks prior to closing and use that for the down payment, closing cost, assuming obviously that you qualify with the increased payment from your equity line. If you're ever trying to get the seller to participate to reduce your out-of-pocket, on investment world, the seller can pay up to 2% of the sales price to assist in down payment or closing costs. When that happens, we a lot of times see the sales price being increased to cover that 2%.
Oh, wow. I didn't know that part. The seller assistance of 2% of the down payment. That's good to know. Um, in terms of the HELOC, I just want to clarify because I personally have used my HELOC to purchase rental property so far. In terms of using that liquid fund and the additional payment that's going to require in the future, how does that get factored in, if any, to the DTI? Is there a science to the calculation? Because I'm not sure the lender might have visibility into that.
But there is no science to it, so that we have to document it. So when customers come to us and say, we're going to use my home equity or my HELOC to use for down payment, we're like, no problem. Please send us your most recent statement and the terms and conditions of your home equity line of credit. That way we can calculate what the new payment's going to be based on their current balance today, plus the amount that they're pulling out for the transaction. So that's why we request that up front, because many banks will calculate home equity line payments differently. Most of them are interest-only payments. Then we have seen some banks that do 5% of principal balance. We've seen some do a percentage of the unpaid principal balance. So that's why we always request the terms and conditions from the consumer.
Gotcha. Okay. And I wanted to backtrack just a little bit on the 1 to 10 scaling of the properties. You mentioned 10 finance properties. So I just want to clarify. Let's just say I have 7 mortgages so far, including my primary residence. And I was going out there and I got a great deal, and the seller was willing to finance it. So seller financing with a first deed of trust. Does that become a mortgage in the eyes of the lender, and that takes up a slot?
Yes, that's correct. So actually, and we'll see that moving in the future, because when you do your tax returns on your Schedule C, we're going to see that basically, or your Schedule E, I'm sorry, we're going to see that you are claiming interest on line 12 of your tax return. So basically, yes, that'll count as one of your 10 finance properties.
Okay. So that's important to note for our investors who I know want to use creative financing. So even if it's a seller and not specifically a bank or credit union, you want to note that that's going to take off one of your slots. So maybe you want to hold off on that until you get your 10, I like to call them golden tickets, because if you're going for a 30-year fixed rate, those are the best terms and rates that you're going to see, in my opinion. So let's go into discussing the use of entities. I know this is a hot topic with investors, especially around asset protection. A lot of these gurus are pitching LLCs and S corporations, C corporations, and just providing some sort of entity structure around purchasing rental properties. I just wanted to share with our listeners how using an entity might be viewed in the eyes of a lender. Can you talk to us a little bit about this?
Sure. So pretty much I do residential lending only. So that means we lend to individuals. We don't lend to corporations. So basically an LLC is a corporation. So once most investors are setting up corporations, they are doing it for asset protection. They are doing it for other different reasons that people are recommending to them. Again, that's a corporation. So according to Fannie Mae and Freddie Mac, we lend to individuals. So basically that means I can only put the loan in the name of yourself, the borrower. We cannot use an LLC. When most investors come to us, they'll basically say, well, we want this as an investor. We're going to transfer it after closing. Well, they can do that. I know there's a lot of investors out there that will do that, but they are violating the due on sale clause that is in the mortgage. So, and that due on sale clause is the same for every lender. Okay. So pretty much what we suggest to individuals is basically just be aware of what you're doing. And recently, in the past 6 months, Fannie Mae has come out and said, they will allow a lender to grant permission to transfer into an LLC after closing. So this is relatively new, but the people on the loan have to match the people on the LLC. So if there's one borrower on the loan and they basically give us the documentation for a single member LLC that matches the person on the loan, Chemical Bank will normally grant permission for that title to be transferred to the LLC. So if there's two people on the mortgage, basically, and they want to try to get into an LLC, basically both the same two people have to be on the LLC doc. So all the LLC docs have to be reviewed post-closing by our customer service team, and then they'll grant or not grant permission to put in the LLC. And then there's other investors that will do an umbrella policy with their insurance agency, and they'll just basically keep adding their different properties as they purchase them to an insurance umbrella policy, which will basically provide similar asset protection.
Awesome. Thanks for sharing that. I had no idea that Fannie came out with this relatively new topic. Is this reviewed on a case-by-case basis? Are there certain metrics that an investor might hit to get approval from Chemical Bank?
It's a case-by-case. So basically, obviously, once they request permission, basically the chemical customer service will ask for their copies of their LLC documentation to see if it meets Fannie Mae and Freddie Mac's checklist of certain items. And basically, like I said, if it's just one person on the loan and a single member LLC, I have not seen them deny the request. But again, I'm not an attorney. I don't know all the logistics about the LLCs, but we have a group that will approve or decline them after the closing takes place.
Gotcha. And is there a fee associated with this request and transfer?
There's not a fee from the bank, but you're going to see, because you have to prepare a new deed and you have to record the new deed with whatever county this particular property is. So I usually tell a customer you'll probably see anywhere from $150 to $200 in cost that they'll apply to an attorney or anybody that's going to help them transfer the deed from their individual name to the LLC.
Perfect. I also wanted to talk about the refinance process. There's one strategy that I personally like. It's called the delayed refinance. This is a cash out refinance. And Sean, I was wondering if you can share with our listeners what this program is.
Sure. Fannie Mae has a delayed financing program where basically allows an investor to refinance the property. Assuming they pay cash, they can refinance it within 180 days. So the magical 180 days used to be you cannot refinance a property for 180 days if you wanted to take a loan out above the original purchase price. So recently, a couple years, Fannie Mae's come out with what's called delayed financing. What that means is as soon as you close on a transaction, we have to prove that you came up with the funds yourself. If you borrowed them from a HELOC, you got a loan from somewhere else, that's acceptable, but any loans you received to purchase this property have to be paid off with the refinance cash out. So with delayed financing, if you refinance the property in the first 180 days, on a single family, you're maxed out at 75% of the appraised value, not to exceed the original purchase price, plus any closing costs, assuming the appraisal allows you. So with a delayed financing, you are capped or restricted to that original purchase price. Basically, it does not include rehab dollars that might go into a property. It's strictly based off the purchase price that's on the closing statement or the HUD statement. And if it's a 2 to 4 family, the maximum loan to value is 70% on a cash out refinance. So if your appraisal warrants you enough to get cash out above and beyond the original purchase price, then you have a decision whether you want to get the cash out now for the original purchase price, or you can wait 181 days in order not to be restricted to the original purchase price.
Okay. I wanted to ask you, doing over 60 loans, closing over 60 loans a month, I'm sure you see a ton of investors and deal flow and what the market is kind of doing. Do you have any input or insights into interest rates and what you feel like the market is going to do in 2019?
Obviously, nobody has a correct answer to this, but I think the market in 2019 is going to be very favorable. I think it's going to be pretty flat and consistent with where it is today. Everybody's seeing the economic challenges that we're going through as a country today. We're seeing the stock stock market going up and down 1,000 points at a time. We're seeing that 10-year Treasury 2 months ago, that was above 3%. It's recently dropped below 3%, down to like 2.5, 2.6. So that lower that 10-year Treasury is, the lower the interest rates go. So the better the rates are going. So in the investor world, I try to share with people, don't get too caught up in interest rates. I mean, obviously, we all want the best interest rate. We all want the lowest closing cost. But as the market changes, what I've seen and what my research has seen is as rates go up, we're tending to see the millennials aren't purchasing homes. They would rather rent. So basically what that means is there's more opportunities for investors. So normally with the investor world, if the rates are slightly higher, that means your rents are going to be slightly higher. So usually you get the same cash return regardless of where interest rates are, because if the rates go up, that means rents are probably going to go up. So if the rates stay the same, that's great for investors because cash flows is going to be great. If rates tend to go up, we're going to tend to see rates go up or rents go up a little bit. So it's a perfect world for the investors out there. And I try to share with them, don't get too caught up on the rate and the rates that are out there, because again, it's going to be made up somewhere probably in the rent.
Any parting words of wisdom for our listeners?
Just two things that jumped out during our conversation. One, we just talked about interest rates. So pretty much keep in mind, interest rates are going to be higher than when you buy an owner-occupied property. So with Fannie Mae, basically once you're buying a property and you only want to put 20% down, they're going to charge like 3.5 points because it's an investor with less than 25% down. So most of the time we're looking at a higher rate of interest to offset those points. So at that stage, I'm going to give you, the consumer, a chance to do a 0-point loan, which will drive that rate probably up near 5.875, 6% based on the current market. To do 0 points, then you can pay points, which is a percentage of your loan amount, to purchase a lower rate of interest. So we can do a break-even analysis per transaction. If you put 25% down, you do get much better interest rates. So with 25% down, Fannie Mae will charge you 2.5 points per se. And basically, again, if we tried to use the higher rates to offset those points, you're looking at rates like at 5.375 on a 30-year fixed, where owner occupied today is probably at 4.5 on a 30-year fixed. So basically, just keep in mind there are different rates as investors that basically help with the risk. The second is basically, we talked about the process in the beginning, how Chemical Bank separates themselves. There's also a post-closing benefit that an investor has to look forward to, meaning if you go out and you partner with a bank that you like, Chemical Bank, we service all of our mortgages. So although we sell them to Freddie Mac, Fannie Mae, we maintain the servicing. So once you start getting to 4 properties, 6 properties, 9 properties, you need a partner that if you have a question on one loan, you can go to one bank and get a question on 2 or 3 of your files or whatever you have questions on. Whereas if you're out there just basically going with different banks, different times, now you probably created a little situation for yourself where it's going to be getting tedious if you have problems or questions, because you're going to be a number to a bigger bank, whereas we're in the market to provide customer service. So we not only want your first transaction, but we want the next 9 that go with each specific individual.
That's awesome. Thanks for sharing that. And I really enjoyed this conversation. How can our listeners reach you?
Okay, you can go right to my website. My website is just my name. It's www.shawnhuss.com, and that's SHAWN, HUS as in Sam, S as in Sam.com. That'll take you directly to my Chemical Bank website that has basically, you can apply online to get pre-approved. It has my office number, my cell phone number, my email. Definitely feel free to reach out with any questions that you have, and definitely looking forward to the opportunity to educate anybody that is ready to get into the investment world.
Yeah, and I have called Shawn on his cell phone numerous occasions, even on 6 p.m. on a Friday. So I can testify that he does pick up his cell phone. Not that it's recommended that you all call his cell phone, but he definitely is reachable. Shawn, I really appreciate your guidance on all of my investment properties, and I look forward with working with your team in the future.
Any and all referrals that you provide are greatly appreciated, Bo, and what you're doing for your friends and other investors out there is awesome.
Thank you. Well, I'll have this interview and all of the show notes on our website. And if you have any questions, you can feel free to reach out to me at bo@biggercashflow.com. Thanks for listening. Thank you for listening to the Bigger Cash Flow podcast. Please remember that opinions of the guests are their own, and nothing on this show should be considered personal or professional advice. Please consult your tax, legal, or financial advisor for personal advice that fit your unique situation. See you next time.